What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is January 16th of 2025. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to do a broad analysis of three of the most popular Layer 1 protocols in the crypto industry: Ethereum, Solana, and SUI. I not only want to spend some time to analyze their price action in a variety of unique ways that can give us more insight beyond just their dollar terms, but beyond that as well, I want to look at the hard data, the fundamental on-chain data, to understand where these protocols currently stand in terms of adoption, and outside of that as well, talk about the general benefit of each chain from an investment perspective. And you may be surprised on what my outcome is when it comes to these plays. We got a lot to unpack here in today's video, as well as a sponsored review of Marinade Finance, one of the biggest staking protocols within the Solana ecosystem. So stay tuned for that. You guys won't want to miss it. So let's go ahead and kick things off here. First off, I want to talk here about Ethereum. Now, the first thing you have to understand is that for all these plays here, I want to be analyzing them in terms of Bitcoin, right? Because at the end of the day, we want to at least see that protocols are at a point where they are on a trend of outpacing Bitcoin. And this actually leads me to talking about Ethereum, because as it probably doesn't come as a surprise to many of you, while obviously Ethereum, as all cryptos, are definitely up over the last couple of months with the recent uptick and much higher than where they were, say, back in 2022 in the depths of the bear market, Ethereum has been really a laggard at the end of the day. And the reason why I focus on Ethereum and price action first is because at the end of the day, we may really like something fundamentally. We might think something is really cool, and there might be some awesome applications like Uniswap, Compound, or Aave on the Ethereum network. But from a trading or investing perspective, if the protocol itself is not outpacing Bitcoin in a significant way, then I'm not going to be too on edge to be exposed to it, right? Now, the big thing here I want to emphasize is if you just take a look from a price perspective, Ethereum set in its all-time high against Bitcoin in November of 2021. Or now, technically stepping back here, there have been higher price points, but what I mean is that that was the last significant relative high against Bitcoin. And ever since then, it has really been on a downtrend with lower highs and lower lows. So you've been better off over the last more than 3 years holding Bitcoin versus Ethereum. Not a really good look here. Now, at the same time, I'm also someone who, while I've been generally speaking out against buying Ethereum, even though we bought Ethereum when it was like 80 to $100, we bought it in what we call the golden accumulation range. And we made a killing on DeFi Summer back that time around on Ethereum. That was one of our best positions. At the same time, while we've obviously been calling for this downtrend in Ethereum for a while, we also may be able to spot some opportunity because we have gone down over 64%. So it may be that Ethereum is oversold, and with the upcoming administration in the United States, we might start seeing some broader adoption of Ethereum, and more particularly Ethereum-based DeFi. So I definitely don't want to shoot down the idea of purchasing Ethereum. But what I want you guys to understand is that until we can start trending past some of these long-term moving averages, like at least reclaiming the 21-day for that matter, but getting above the 100-day, I really wouldn't be touching Ethereum too much. And if we take a look from a fundamentals perspective, we might understand why Ethereum is stalling. Now, in stablecoin liquidity, we've actually gone past the relative highs in February 21st of 2022, where it was around $101 billion. We've seen a resurgence here since back in November, a really solid increase here from 83.5 billion all the way up to 113 billion. This is incredibly noteworthy in my opinion. This actually speaks to real adoption on chain. Stablecoin liquidity usually moves in to provide liquidity on DEXs or to be used in lending and borrowing protocols. So this is a very important metric to keep in mind here. And this resurgence speaks to that recent surge in optimism. At the same time, though, the ratio here has been relatively low against the growth against Bitcoin, right? It's been pretty much neutral. And in fact, since that period of time, it's actually ticked down a little bit since Bitcoin. So there may be a really good opportunity if this growth continues for Ethereum, as I mentioned earlier, with the new regulatory regime, to be able to make a sort of comeback here. But when we look at the real on-chain fundamentals, and I think another metric that's probably just as important because it speaks to usage, is app revenue. This is all data that you can access through DeFi Llama. What you will find is that while we have these kind of general peaks, the application revenue that is generated from various protocols has gotten nowhere near where it was back in 2022. And I know some people will say there's a variety of EVM compatible L2s that we have to consider, like Optimism and Arbitrum and Polygon. The list goes on. There are so many different forks and attempts to be able to serve as layer 2 scaling solutions, ZK Sync. The list goes on and on. No matter where your opinion stands on whether or not these have been net contributors to Ethereum from a fundamental perspective, they have most certainly hurt Ethereum from an adoption of ETH as a currency, as most of these networks have their own layer 2 currency like Optimism or Arbitrum or Polygon. So because of this, I think this has put a huge damper on the demand for the core asset or collateral ETH, which is the main currency of the network, through this kind of multifaceted layer 2 scaling. And we can just see generally that the core app revenue generated on Ethereum's network has diminished over time. It's not really been able to break to new highs during this bull market. So Ethereum is more of the slow growing, low risk defensive play that could benefit maybe with a broader adoption of traditional finance in the next couple of months. But along with that as well, we also have Solana. Now, Solana, unlike Ethereum, has been generally neutral with Bitcoin for the last year. One could argue that, for example, from the relative peaks here, we've been maybe on a slight decline, but I would say, generally speaking, Solana has kept up with Bitcoin here, to be fair. When we look at the longer term trend, it had a great expansion from the bear market lows and has pretty much been on par with Bitcoin, even going as far back as August of 2021. So considering that here, that Solana has had more neutral price action with Bitcoin, this probably speaks to the growth that we've been seeing from a fundamental perspective. I'm a little bit more optimistic to be building positions in Solana just from a pure trade perspective versus Ethereum, considering that we're spending much more time in relation with the 21-day. And along with that as well, we at least kept neutral here. And we're still well above the 200-week, whereas on Ethereum, it's a very different scenario. The 200-week was broken a long time ago and is still declining, right? Now, why is this? Well, it has to do with, similar to Ethereum, on the stablecoin market cap, so this includes all the USDT and USDC bridged over to the network or minted on the network. We've gone from the bear market lows of around 1.5 billion all the way up to 6 billion. So we have seen a 4x multiple in the amount of stablecoin liquidity, and that's very much on par with where we were here in the peak around 2022, where we saw stagnation and then an unwinding as the bear market played out and the whole FTX debacle played out as well. We can also see on some other main network traffic metrics that we have, like app revenue, as we did with Ethereum. What we see here is a real growth story, far well in advance from where it was in 2021 when Solana was more, in my opinion, I wouldn't say it was an empty shell, but it certainly wasn't versus its valuation multiple worth as much as it is from a fundamental perspective today. It's at a much more healthier app revenue to market capital multiple. We can see that we've had an explosive amount of growth here from the peak, which was generally around 200 to 300K, to where now daily we're seeing upwards on peaks of 3 million, even during slower periods here. Essentially, the prior bull market euphoric high served as the base here, even in the slow time during August and September. And we just hit a new high back in November of $80 million in fees collected in apps in a single day. But even with this pullback here, right, as we've kind of simmered down, the markets are not as euphoric as they were back in November. We are still seeing around $5 million to $4 million on a daily basis. And that's well above what we saw throughout the majority of the first half of 2024. So this is really telling here. There's a real growth story here at the end of the day. And as someone like myself who's been on the fence about Solana, I've had my criticisms of it before, as I have had with Ethereum or any other protocol. This at least looks good. People are paying these fees, right? So because of that, we need to at least take the merit of those metrics. And focusing back on the topic of price action, it probably comes as no surprise that as Ethereum has been bleeding out against Bitcoin, Solana has been outpacing Ethereum. And it's done something quite important here back in the month of December. Looking like, at least so far, we've been able to turn the prior historic range of resistance from back in November of 2021 on Solana against Ethereum, as well as the relative highs here in December, as well as March and May of 2023 and 2024, now into potentially new support alongside the 200-day moving average. If we can really get a break above here to 0.065 on the ratio, that would be pretty telling to me that Solana is here to stay, and it's probably going to continue outpacing Ethereum. Now, the next thing I wanted to talk about, and we will review Solana from a price action perspective in just a little bit, is talking about SUI. Now, SUI is one of the newest players in the scene. The protocol has been around for a few years now, but really has started to garner traction here over the past, say, 6-7 months, really coming to the scene in a big way over the past few months. And what we can see here is that when we take a look at some of the core metrics we utilize on a variety of other networks like Solana and Ethereum to measure, kind of some means of actual adoption, what we find here is that SUI, I think very similar to Solana back in 2020 and 2021, is serving more as this kind of empty chain that has maybe a lot of technological capacity and ability to become a major L1. A lot of people are obviously buying into the narrative and excited about it, but we aren't seeing that sense of adoption on the network. We're not seeing massive institutional inflows. A couple $100 million of stable coins has been sort of the norm here throughout 2024. And while we're back on the upper band here towards 437, this is basically where it's topped out 3 times since back in May. So this doesn't really look like the growth story that many people are promising us, right? People are buying into it for its potential, and I can understand that. We'll discuss that a little bit later on. But at a minimum, the price acceleration and the market cap valuation of SUI is probably not matching as strongly towards its fundamentals. We can even see as well for the app revenue, there has been some expansion since back in 2024. More, generally speaking, we were seeing around $40,000 to $50,000 in actual volume per day. We're now seeing something more like 100 to 200K in volume on a daily basis. So there have been improvements on those metrics here. People are utilizing the chain more. This is probably, again, arguably one of the more important metrics, but I think long-term the stable coin is really the thing that helps you filter out whether or not it's just short-term kind of wash trading volume, fake activity to get people really riled up. Right? You really need to see that increase of dollar liquidity, which speaks to new participants coming in, more use cases attracting liquidity to the network, real sensible adoption, which I just don't think we've seen in SUI yet. There's been a lot of rehypothecation and a lot of the same things that a lot of L1s do to kind of stand out early on or look good. Another way to kind of view this is bridge TVL. You can also do this with other networks. Solana has had a slight uptick over the last 6 months, but generally speaking, I don't think in Ethereum you're going to see too much bridge liquidity because it is kind of the predominant source of liquidity in crypto. But as an emerging L1, what we see here is that there's been about a 50% increase in bridge TVL since back in November, since the market really kicked back up again. Right? And that's in dollar terms, right? So if there's, if it's stablecoin liquidity of some sort, right, that's really great. But we already looked at the stablecoin metrics, which are pretty neutral. So what we're looking for is essentially other bridged assets, crypto assets, to provide in liquidity pairs or used in different types of DeFi protocols. So this really isn't too exciting considering the price appreciation since back in November, right? So again, at the end of the day here, I'm not here to bash SUI or anything. It is the new kid on the block. It is the highest growth potential play out there in the event that it does well. And so far, over the last half year, it has been heavily outpacing Solana. If we do a custom ratio of Sol BTC divided by SUI BTC, we can see that essentially Solana has essentially, not kept up with SUI by a long shot. It's down about 82% versus the price performance of SUI during that time. That doesn't mean Solana's down significantly. It just means that SUI has been doing a really great job at outpacing Solana. That being said, though, we are coming here towards a pretty important range here between July and September 2023. This was a mid-range here of consolidation. And so far, even though we went down as much as 85%, that has started to tick up a little bit here. So we're starting to see Solana potentially regaining ground against SUI. Now, the big thing here I want to talk about is, as we just kind of take it home here, a lot of people are probably wondering, okay, Nick, so what's your verdict? Do you have one particular protocol that you think we should go all into? Should it be more of a distributed approach? And I would say it's the latter of the two. I think we need to consider here that putting all your eggs in one basket has always been pretty risky in crypto, especially when there are much more options in the table as there are now. But beyond that, I think it's imperative to understand that each of these 3 networks have a really solid benefit to them that I think justifies a 33% or essentially third split between each protocol. So I'm not saying, again, put all your capital in just these 3 plays, but for any capital you'd want to allocate to layer 1 plays, I think having a third in Ethereum, having a third in Solana, and a third in SUI is a great approach. And I'll talk about why that is. Because if you consider it as kind of a low risk, right, Ethereum being at a $400 billion market cap, it's kind of the low growth, low risk play. It's going to be a lot less volatile. You've got Solana, which I would say is still in a large cap valuation, but is a more medium risk, medium reward growth play. And SUI, which is down here at $13 billion, right? A fraction, not even 1/20th of the market cap of Ethereum, right? So if we're considering the market can continue expanding, that all these plays should go up to some degree, and that SUI is down here at just around a $13 billion market, making it that kind of high risk, high growth potential play. I think what you're going to do is get a really good balance between the broader performance of these, because it could very well be that SUI has what Ethereum and Solana had. It has its moment this cycle, and it really is the play that you definitely want to have some exposure to, because it could do that 10, 20x multiple in a really big altcoin cycle. That being said as well, SUI might fail. And you might see Solana continuing to charter forward here and become the predominant L1. It may not only become the predominant L1 in the crypto space by all key metrics, but it may even swallow up a lot of the demand that might come from centralized finance as it starts to merge and integrate into Web3 with real-world assets and other different types of narratives. However, if the push for DeFi from traditional institutions and CeFi really goes to Ethereum, as we're hearing from BlackRock and a lot of the major players out there, that's going to be the predominant platform for tokenizing assets, real world assets, and other different types of narratives. And we see more broader institutional adoption of DeFi. You don't want to miss on that, because that could still be a massive multiple expansion from where we are now, like a 2 to 3x, right? And it may be that Solana and SUI fall by the wayside. So my belief here is that you want to have a good split between these. And you could even reduce each one maybe down to 25%. So you have another additional 25% of your portfolio that you can allocate to other L1s like Cardano or other plays that you're really big fans of, right? So just keep that in mind here. I don't want to speak in absolutes, but I think that's a great way to approach it. And generally speaking, in an altcoin cycle, it's an all tides, rising tides lift all boats scenario, so that they should all do well. But you have that fractional exposure to something like SUI where you're still going to be able to make great returns, as well as Solana and Ethereum, in the event that one of these networks really shines, which could very well be the case. And that's why we want to make sure we maintain some degree of diversification. So I read out here a good amount, guys, but I'm curious what you guys thought about this breakdown. If you did enjoy it, consider dropping a like. And I want to go ahead and kind of segue here into talking about one of the biggest app-centric protocols on the Solana network, which is really, again, as I'm someone as a trader, I like to focus on the medium risk, medium reward plays. And Solana really is that in this cycle. So I want to spend some time to talk about one of the biggest and strongest fundamental projects on that network. Alrighty, everyone. So in today's video, I want to spend some time to not only talk about one of the most fundamentally strong projects in the Solana ecosystem, but along with that as well, a project in which is actively decentralizing the Solana network as time passes. Today, we're talking about none other than Marinade Finance. Now, for those of you who haven't heard about Marinade Finance, they're not only playing a pivotal role in further decentralizing the Solana network, which is absolutely necessary in the long run, but along with that as well, it is actively working towards maximizing the stake yield for those who are delegating their stake within the Solana network in order to earn an APY or yield. So I want to spend some time to talk about how Marinade Finance does this, why it's really the best on the market, and outside of this, we'll talk about the strong fundamentals behind this project, because there are not many like it out there, especially for projects solving such a core issue within the broader network. We got a lot to unpack, so let's go ahead and kick things off. Now, first things first, the big thing that really stands out to me when it comes to Marinade Finance is that it's a fair launch, non-VC backed project that's been around as far back as 2021. And in Solana land, that's a long period of time. But Marinade Finance has been around for a while because the problem it's been trying to address is a well-known one. Not only is it important to maximize your staking yield on Solana, so essentially allowing individuals to be able to, in an automated fashion, be able to get the best yield possible for their stake in order to help in validating the network. But along with that as well, being able to have the network be made up of a larger pool of validators who are actually playing a role in consensus and delivering new blocks and confirmations on transactions in the network. These are two predominant issues that are tied together, and essentially Marinade has been able to build a system with its new V2 launch that allows us to do this in an entirely trustless and non-custodial way. So I want to go ahead and talk about this. So essentially from a core simplification concept, right? There are really two major parties here that are interacting with Marinade as a protocol. You have the people who are stakeholders. It could be someone like yourself or myself who might have some Solana and we're holding it for the long run and we want to get that juicy 10% APY. We're going to talk also about the yield later on, how in this case Marinade is able to provide the best yields on the market. But beyond that, it's well known by most people that you can get a staking yield on Solana. And you do this by essentially staking your tokens. And what this allows you to do is be able to delegate your voting weight by the amount of stake that you own through delegated proof of stake to a particular validator. So these validators out there are competing for that stake in order to be able to validate on the network and have transaction confirmation, but also to benefit from a lot of other features in being a validator. So we'll talk about that as we go throughout this. But the main thing above all is that V2 essentially allows everyone to play a role in further decentralizing the network. In V1, originally on Marinade Finance, you had to go through a conduit, a smart contract, to be able to facilitate this and to be able to delegate across multiple different validators. That is now no longer the case. In this case, you get to keep your SOL and essentially pass your delegation voting or staking authority to the Marinade proxy, which goes on towards a whole pool of validators. To put into context how much Marinade has been able to further decentralize the network, this one particular protocol has essentially taken Solana from a position where there was probably a handful, maybe a dozen to 20 validators, to hundreds of validators. And to put it also in further context, instead of about 10 validators having enough voting authority in order to dictate the state of the network, which is very centralized and high risk, it has now moved up to around 19 to 20. So they've effectively been the key pressure point that has led the network to doubling in its decentralization and will likely further continue to decentralize over time. So this is a very important point here to understand and just how powerful Marinade has been in further playing that role of decentralization. So there's not only great protocol updates that are becoming less trustless at the end of the day, but along that as well, you also have 100% uptime protection for staking rewards. So I want to talk about why this is very important. Essentially, if you are delegating your SOL tokens to a validator who, for whatever reason, their infrastructure, wherever it's hosted, how powerful it might be, is having downtime, right? So it means it's not producing blocks, it's not playing a role in validation. That is going to hamper and dampen the amount of yield you're going to earn on your stake yield. So essentially in the new V2 update, you have 100% uptime protection for staking rewards, meaning that your realized APY is going to be very consistent. You're not going to deal with the consistent downtime of either running your own validator or trusting a particular set of validators and just hoping for the best. Because of Marinade Finance's large pool of validators and their on-chain validator SLAs, this essentially guarantees that you'll be able to have 100% uptime. And again, you can take a look at a lot of the on-chain data. You can see how Marinade has been running for the last couple of years. This has been one of the most consistent protocols in the ecosystem and fixing one of the biggest issues that still happens from time to time when it comes to staking the Solana ecosystem, or let alone in transactions. You constantly will deal sometimes with validators not being able to keep up with the demand of the network. So this is very exciting. And outside of that as well, the important thing to understand here is that the staking yield is highly competitive for a couple of reasons. The first major thing is that it's run through a marketplace. So instead of V1, where essentially you were just getting the inflation rewards from validators on the network, not only is there a more active marketplace of validators now who are essentially competing to have the best uptime, to pay out a larger APY, but the big thing here is that there's new features baked into Marinade Finance that allow for these different validators to compete even more for your stake. Fees in which they used to collect themselves. For example, in this case, Michael, the chief strategy officer over at Marinade Finance, tweeted out that the overwhelming majority of the revenue that validators are generating, over $161 million, are coming in the form of transaction fees, not just MEV tips, as well as new SOL issuance, which has been the case for a lot of its history. Well, now with Marinade Finance, for the first time, while this revenue used to be completely gatekept to just the validators, it was an expectation that validators would be able to keep all this revenue. Now with Marinade Finance, there is a built-in capacity where validators can compete for your stake and essentially offer to share a portion of those fees in order to remain more competitive. This is really exciting. It means more stakeholding for you as the end user, and it's going to encourage a lot of large validators to essentially have to play ball with a larger pool of competitive validators who are all working ideally at not only further decentralizing the network, but prioritizing giving the best yield back to the everyday users who make up the network. This is really exciting in my opinion. So this is a big dynamic here that is going to allow for the network to be able to be more prosperous long term, being able to pull into MEV tips and transaction fees. This really changes the game for Sol staking. It will make the APY much higher as long as network demand keeps up. And outside of that as well, make Marinade Finance a premier platform that's going to draw more stakers and ideally more validators, further decentralizing the network. So in order to understand how it really works, I think most of you probably get the concept by now, but I wanted to demonstrate what it's like to use Marinade Finance, and it's a really responsive application. It's quite simple. If you want to come here and you want to stake your SOL tokens, I've got a little bit here in my wallet. I'm going to go ahead and click Start Earning SOL Now. I'm going to go ahead and stake close to the max, so I'm going to do about 0.4 here into the protocol. Now, this is again important to understand here that you can still use the old way of Marinade Finance, but you can also use the new one as well. So there's a couple different strategies that you have the ability to utilize. You can use native, which again, as we talked about earlier, requires no smart contract exposure. We have full custody of our assets. We're purely working through the proxy of the Marinade Finance protocol. Or we could do liquid staking, where essentially we get IMSOL tokens, can participate in DeFi with 20 different integrations. So this is essentially a claim on the tokens we've put into the smart contract that we can again go out and utilize still in any protocol who might use Marinade or IMSOL tokens. But in this case, I'm going to go ahead and use the liquid staking, as native requires that you have at least one SOL token. Again, relatively low barrier to entry here, but it is a minimal requirement if you want to use the native staking within the protocol. So essentially we can go ahead here. We can see that we've got our priority fee. We're going to go ahead and stake our 0.4 SOL. We're going to go ahead and click confirm. And just like that, our Solana is staked within the network. So if we click back to overview, we can see our active amount staked here and the protocol, and we can see the APY we're going to be earning on that, and an ability to unstake right here from within the protocol. But you can also see as well, if you check your Phantom wallet or other compatible Solana wallet, we also have our Marinade staked SOL tokens right here. So again, we can go utilize those if we're using the traditional liquid staking feature to be able to go out and interact with various DeFi protocols. It's the same way, for example, if you have liquid staking tokens for Ethereum or other different types of tokens on the respective networks, where you can go out and use them in secondary ways. But again, remember that that is the claim to your underlying position. So you don't want to be willy-nilly with it. You want to make sure to protect that, make sure that you have security on it, just like you would managing a traditional unstaked position. So we can see here again that we've got the ability to see our APY. It's really self-explanatory. There's nothing too crazy or complex about it. And that's what's so great about Marinade Finance. It's solving a massive problem for the network long-term by making it more decentralized and resilient. And at the same time, you're getting the max APY on your coins, over nearly 10% here on an annualized basis. That's really good. Now, outside of this as well, there are a couple different things I wanted to dive into. You can obviously dive into the network details, covering the network score here, about the decentralization of the network. You can see essentially what different validators are helping to validate the network, the breakdown of those validators and how much SOL is delegated towards them, and also where they're based as well as their ISPs. There's a whole range of different awesome analytics here that you can dive into. But the big thing above all that I wanted to spend some time to talk about is the fundamentals on chain. Now, when we talk about the governance or DAO within Marinade, as well as the token, as well as the protocol itself and the treasury, there's a lot of exciting things to look at. The first thing that I just like to see here, the first thing I'm always thinking about beyond thinking about optimistic thinking within crypto is the project real, and are its intentions genuine? Is it a place where I would feel safe putting my money? After Celsius and BlockFi, after so many project collapses, Terra Luna, you name it, you got to be about your wits at the end of the day. And what I really like here is that on DeFi Llama, which you can get access towards a whole range of different DeFi analytics, we can see here that Marinade has been operating soundly since back here in 2021 and has maintained a very solid foothold here in the Solana ecosystem, averaging around 8 million SOL practically consecutively or consistently on the network, albeit with some periods where we go above and below it. So this is really exciting to see that Marinade has maintained strong uptime. It has maintained a competitive APY, hence why it's been able to have so much SOL delegated towards its protocol. But beyond that as well, for Marinade, even beyond the metric of tracking how much Solana is staked within Marinade Finance, this is one of the strongest revenue generating protocols in the Solana ecosystem. They brought in over $15 million in fees in the last year. And along with that as well, the DAO itself owns about a 10% stake in the amount of SOL staked within Marinade Finance. So there's a lot going strong for this, not to mention from a pure valuation perspective in market cap terms. Whether you're looking at the circulating market cap or the fully diluted valuation, $127 million fully diluted valuation for the revenue it's bringing in here is much better on a fundamental ratio versus what you find in most Solana projects. So this is really great to see here. Such a well-known resilient project, one with a lot of great volume, listings across a lot of major exchanges, even including Coinbase, as well as Crypto.com, and of course all the major Solana decentralized exchanges. This puts it in a really great position to be able to continue bettering over the next couple of years across a lot of different competitors in the space and helping Solana to really reach the vision of being able to replace Ethereum one day. I understand that there's a lot of the transaction volume and a lot of the excitement around Solana, but we can't ignore the fact that long-term Solana is going to have to make what it makes work right now in a much more decentralized way if it wants to become the pillar of decentralized finance long-term. So I think that this is a very exciting proposition here. I think Marinade is continuing to keep it simple, but also focusing on some really exciting innovations on making sure that their really simple business model continues to be more relevant and useful for its end users. So if you're interested to learn more about Marinade Finance, check out the link down below in the description where you guys can find some more details. I'd love to hear what you think down below in the comments, whether or not you guys are excited about Marinade Finance, what it could bring to Solana as a network in the long run, and whether or not you're curious about anything related to staking on the protocol. If you're interested, you can always check them out, as I'll have a link down below to their Twitter at Marinade Finance or their X profile, where you guys can follow all the recent updates. I definitely recommend you guys watch this video as well, again from Michael Repetny, who is the Chief Strategy Officer of the protocol. It'll give a lot of great grounds on what Marinade Finance is, what V2 brings, if you didn't get everything from this video. But I hope you guys have a phenomenal rest of your day, and I'll see you guys right back here in the next one. Take care, everyone, and I'll talk to you all soon.